I bought my first investment property when I was 17 years old. I had no W-2 income, no tax returns, and definitely no credit history. Fast forward to today, I own 153 Section 8 rental properties, generating over $200,000 monthly. That's all because I discovered a financing loophole that most Americans don't know about. It's called a DSCR loan, which is the closest thing to a cheat code in real estate. Today, I'm breaking down exactly how DSCR loans work, why they're a game changer for everyday investors, and how you can use them to build a real estate portfolio even if you have a limited income or less than perfect credit. DSCR stands for Debt Service Coverage Ratio. Unlike traditional mortgages that qualify you, DSCR loans qualify the property itself. Traditional loans look at your W-2 income, your tax returns, your debt-to-income ratio, and your employment history. DSCR loans look at the property's ability to generate income, the ratio between the income and the expenses of the property. That's it. That means you can qualify based off of the property's performance rather than your personal income. It's basically like the property taking out the loan rather than you. It's how I've scaled to over 153 Section 8 rental properties despite not having a job. DSCR loans are perfect for self-employed people. You have no need to show your tax returns. There's no income verification. And it's perfect if you write off a lot of expenses. They work for real estate investors. You buy properties based off your potential cash flow. You scale beyond your 10 loan limit for conventional financing. And you have no need to qualify based off your personal income. It works for people with non-traditional income, like gig workers, commission-based sales, seasonal workers, or even business owners. It works for those with limited credit history. Many DSCR lenders will go down to 620 credit score. Some will potentially even go lower with higher down payments required. But in reality, the focus is on the property rather than your personal credit score. And it's perfect for W-2 employees who are looking to invest on the side because the property's income covers the debt service, and it's perfect for building a portfolio while working full-time. Now the formula is simple. DSCR equals your net operating income divided by your debt service. Your net operating income equals your net income minus your operating expenses. Your debt service equals your principal, interest, taxes, and your insurance all combined. Lenders typically want to see a debt service ratio of 1.25 or greater. This means that the property generates 25% more income than its expenses. This ensures there's a cushion for vacancies or unexpected costs. For example, if a property rents for $1,500 a month, your operating expenses, which are your taxes, your insurance, etc., are $300 a month. Your net operating income is $1,200 a month. Your mortgage payment would equal $900 a month, so your debt service ratio is $1,200 divided by 900, which is 1.33. So this property would qualify for a debt service coverage ratio loan. With Section 8 properties, the ratio is even better. Government guaranteed rent is higher than market rent in many areas. Lenders love the stability of government-backed payments. The minimum debt service coverage ratio on the Section 8 rental properties that I'm buying is at least 1.5. Now, your down payment requirements typically is going to be right around 20 to 25% down per property. Some lenders will go as low as 15% down with a strong debt service ratio percentage. Your credit score requirements. Most lenders are looking for 620 plus. Some will go as low as 580 with higher down payments required. But in reality, the focus is more so on the property generating income than you. Now for the property types allowed, single family homes, 2 to 4 unit properties, condos and townhouses, and some lenders will even do small multifamilies, 5 units plus. In terms of your interest rates, usually are going to be right around 1 to 2% above conventional loans, currently ranging from 6 to 8% depending on your terms. Higher rate is generally offset by your cash flow and your tax benefits. Now your loan terms, generally 30-year amortization is standard. Some offer a 5-1 ARM, 7-1 ARM, or 10-1 ARM options. Fixed rate options are available, but they are at higher rates. Now there is no income verification required, which means no tax returns, no W-2s, no employment verification, and no debt to income verification. Now, where can you find DSCR loans? Generally, local banks and credit unions. They often have portfolio loan options. They may offer better rates to existing customers, and they're usually more flexible on these loans. Mortgage brokers. They have access to multiple DSCR programs. They can shop the rates and the terms for you, and they often work with investors regularly. Online lenders, companies like Lima One, Kiavi, or even Corvest. They often have streamlined application processes. They can generally close quickly, as little as 2 to 3 weeks. Private lenders, for example, high net worth individuals or family offices. They can generally offer more flexible terms but higher rates. Now, how can you approach these lenders? Obviously, come prepared with your property numbers, have your rent comps ready, know your basic DSCR calculations ahead of time, and be ready to explain your investment strategy. Let me show you a real Section 8 deal I recently did with a DSCR loan. The property was located in Dayton, Ohio. The purchase price on this home was right around $67,000. My down payment on this property with 15% down was $10,000. The Section 8 rent on this property is right around $1,450 every single month. Now, my monthly expenses are my mortgage, principal, and interest payment, which is right around $381 a month. My property taxes are right around $82 a month. My insurance at $65 a month. My management at 8%, which is right around $116 a month, and my maintenance at 8%, which is right around $116 a month, which left my total monthly expenses at $760 a month. And my net cash flow on this property at $690 every single month after all of my expenses, which left my debt service ratio at right around 2.74. Now, the crazy part is the lenders didn't care about my income. They only cared that the property's income covered the debt. With a debt service coverage ratio of 2.74, this was an easy approval for them. And it closed all within 21 days. The same deal would likely be impossible with a normal conventional route. They would look at my debt to income ratio. They would count all of my other properties against me, and they would require extensive documentation. DSCR made it simple, fast, and scalable all at the same time. Now, how can you start utilizing a DSCR loan to scale your portfolio? Start with one property that cash flows well. You want to focus on a strong debt service coverage ratio above 1.5. Additionally, you want to ensure that there's strong cash flow all from day one. And almost most importantly, build a strong relationship with a DSCR lender. Now, you can utilize that same existing cash flow to be able to reinvest into more and more properties. And you can aim to buy your next property with your existing cash flow in 6 to 12 months. And then at this point, you just rinse and repeat the process. Each property continuously adds to your monthly income, and each property helps you save faster for the next one. The reality is the compounding effect accelerates over time, which allows you to build a snowball effect. My personal strategies, I started with one property at 17 years old using seller financing, and I used a mix of DSCR and creative financing to be able to purchase every new property. And I focused on Section 8 for government guaranteed rent. And in tail, that's allowed me to scale to 153 Section 8 rental properties within just a couple years. And this is how I went from $0 to $200,000 a month in guaranteed monthly income. No special advantages, no rich family, just using DSCR loans strategically. David had transitioned from fix and flip to Section 8. He couldn't scale with traditional financing. He utilized DSCR loans to be able to purchase 16 rental properties. And he now generates $22,000 a month in guaranteed rents. Henry Cejudo took his earnings from the UFC to be able to build guaranteed passive income every single month. He used DSCR loans to be able to purchase 20 Section 8 rental properties within just 3 months of getting started. He now generates close to $30,000 a month in guaranteed monthly rents. Robert wanted financial freedom for his family. Traditional loans ultimately limited his growth because he had a cap. He used DSCR loans to acquire 34 properties. At this point, he cash flows $20,000 a month with minimal time investment. The reality is none of these people would have been able to scale as quick with traditional financing. DSCR loans made rapid growth possible because they focus on the property's performance rather than the personal finances. They're building wealth despite not fitting the traditional borrower profile. Whether you're looking to buy Section 8 rental properties or any type of rental, DSCR loans are the glitch in the system that you need to be taking advantage of. Now, those of you who want to learn more about how I've built a $14 million Section 8 rental portfolio, check out this video I made breaking down how to get into Section 8 with $0 down step by step. And if you're interested in working with me one-on-one, you can check out my private mentorship program in the link in the description. Thank you for watching, and I'll see you in the next one.